Hey everyone, it's your good friend Eric Thompson. This is the Ninja Selling Podcast. Thank you as always for listening and for engaging. This, my friends, is going to be a very special episode because we have a very special guest. My friends, it is the one and only Matthew Gardner, who is our guest today. The thing is, a lot of you already know Matthew. A lot of you at least know of Matthew Gardner. A lot of you are getting to know Matthew for the first time. And Matthew is known as one of the leading real estate economist in North America. Many people, I would also including me, consider Matthew to be the leading real estate economist. Matthew, it's our honor, it's our pleasure to have you as our guest today. Thank you so much for being here.
Oh, my friend, thank you so much for that remarkably generous introduction. Great to see you again, my friend. You're looking fantastic. Glad you're doing well. I'm looking forward to today's chat.
Yeah, we are too, Matthew. We really appreciate this. Everyone should know Matthew and I go back. I think, Matthew, we've known each other for 15 years.
Yeah.
So, and I've learned so much from you, so many insights along the way. You've helped me to always understand the market. Again, really grateful that you're here. You are humble, so you would never say it this way. But what everyone needs to know is that Matthew is an authority on real estate, the real estate market, residential and commercial. Matthew, you've been featured on CNBC. You've been on stage at Inman so frequently. When there's an article written about the market, there you are being quoted, as you should, because again, you are absolutely an authority. Okay, what everyone needs to know is that we're going to talk about all the things that you want to talk about. I'm going to ask you the questions that you want me to ask of Matthew. We will absolutely be talking about the market, where it is now, why it is the way it is, where it's going. We will absolutely be talking about interest rates. Yes, we'll even talk about tariffs. You know, as a ninja, your mission is to be a proactive, trusted advisor. So what we want to do today with you, Matthew and I, we want to give you takeaways that you can share with your clients to help you to be a proactive, trusted advisor. Okay, so Matthew, before we roll up our sleeves and dig into the market, how about just real quick for fun, a little background. How long have you been a real estate economist?
Oh, good Lord. Thank you for making me sound old.
My pleasure.
It's getting close to 30 years.
30 years.
Yeah, but that's about right.
Okay.
A long time.
Did you study economics at university? Was that your major? Was that your has it always been your field of expertise?
Economics, yeah, in general, yes. So my undergrad, so I went to Oxford for my undergraduate degree, and that was in economics. Was then did a short service commission in the British Army, which actually paid for grad school. And then after that, I went to the London School of Economics, where I got my graduate degree. But it was always basically broader macroeconomics. And I got into real estate because actually it was my first job. And that was actually for a very old and a very established company of chartered surveyors called Cluttons. And that actually was my introduction to real estate and the economics of real estate. Because it's worth, as you know, a lot of money.
Got it. And so when did you move to the States?
Oh, good Lord. 1999, I believe. Yeah.
Okay.
That's 26 years ago.
Okay. Moved to the States, 1999. Terrific. One of the many things that's really interesting about your background, Matthew, is that you worked for the royal family, right? In advising them around their real estate holdings. Do I have that right? I want to make sure I'm saying that correctly.
Yes. I mean, I didn't actually I wasn't reporting directly to the Queen or now the King. But yeah, so the firm I work for, it's been around since the mid-1700s. It has a lot of very, very old clients. And one of them was actually a Crown Estate Commissioners. And the commissioners are the ones responsible for managing the real estate portfolio that belongs to the Crown. And that's actually what brought me across to the States very early on. Because you guys didn't get it all back in 1776. We kept rather large bits. And so that brought me to the US, looking again, acquisitions, dispositions, and the overall management of that portfolio. So yeah, directly for the Crown, they said, not for the King or the Queen, but certainly representing the portfolio of real estate that belongs to the Crown.
Okay, fascinating. So part of that portfolio at the time included assets in the States. That's why you moved to the States.
If you go to New York, I guarantee you've walked on Crown property.
Got it. Got it. That's fascinating. Well, we have that to thank for the fact that you live in the States now and the fact that you have become an expert, absolutely, at North American real estate.
Mm.
One thing I'll share with everyone before we dive in, if you haven't had the chance to hear and see Matthew on stage, put that on your list. We talk about bucket lists and life lists here at Ninja. Put that on your life list to see Matthew Gardner from the stage. It is an experience. It is so insightful, so valuable. Matthew, you're so good at taking complex information, making it be very simple. You're very funny. The time always goes by really fast. So I know we have a lot of brokerage owners who are listening to this. Consider Matthew. Back when I was a part owner in a real estate brokerage, Matthew, I hired you. I think it was for 7 years in a row. You would come a year in January to put on an event for our clients. We would pack the house. We would have 500 to 600 people in a hotel conference room. They look forward to it every year. You would do a terrific keynote address, and it just helped us to be positioned as proactive, trusted advisors. So just a quick plug, a quick encouragement for people to get the chance to see Matthew from the stage. Okay, Matthew, it's time now to talk about the market.
Yes, sir.
Okay, so we're recording this, Matthew, in pretty much mid-July. And so we're in essence halfway through the year. And it's so interesting to me, Matthew, to look at metrics that pretty much the same as last year or flat compared to last year. So we're having today around 4 million transactions per year of existing homes, pretty much the same as last year. Prices are up just slightly over last year. Interest rates are pretty much identical to where they were a year ago. One stat that's different is that new homes are down. New home sales are down considerably, I think down 13%. So here we are halfway through the year. Are any of those stats a surprise to you? Or are any of those different than what you were thinking about and looking at 6 to 8 months ago? Like how are you seeing the market today in terms of what you expected?
Okay. I think that one of the biggest surprises is not that sales are flat. In fact, they're very modestly higher. Single family were up, I think, year on year about half a point, I believe. But it is prices. I mean, they rose 2%. And they are now, this is the data for June, at an all-time high. We've never had sale prices as high as we saw them in that month. So I think that is a surprise, given where mortgage rates are. I know we're going to talk about that a little later on. So you are flat. Now, part of that is because condo sales are down year on year. And so that's been a bit of a drag, but it's a small component of it. So I think what's curious to me is that we're still seeing prices aren't collapsing as some had anticipated. Transactions that certainly aren't rising. I think a lot of that is due to uncertainty, not just that, but also where borrowing costs are, and that's mortgage rates. Now, on the single family, so on the new construction side, rather, yeah, actually, we've got some fresher data out. So the June data, 627,000 annualized, that is down about 6.5%. Is that a surprise? Well, I think a little bit. The reason why I say that is it's pricing. Prices are down year on year of a single family new construction home in this country by about 2.9%, so just shy of 3%. So I think what's curious about the market in general is that we've seen a flattening in listings, and that's actually fairly normal because of the summer. And everyone's actually been talking about the 15% increase in listings compared to a year ago. Yeah, but does it make sense to just look at last year? I'd say no. I always like, and I think some of your ninja people as well should do this. Look at where we were in the same month in 2019, the last pre-COVID year. And if you did that, what would you see? Well, you'd see listing inventory down by 21%. So it's very easy to look at the headline number. It creates, again, the media loves it because they always look for doom and gloom in the marketplace. But is that really the case? I'd argue not. Another surprise probably was that month over month, we actually saw sales rise in the northeast of the country and in the Midwest. So they're less susceptible to where the market is today. Down significantly in the south, but the western United States down about, 1.6%, I think. But the biggest thing for me in general, Eric, is that prices are holding up given where rates are. And technically, in not a buyer's market yet, 4.7 months of inventory at the current sales pace. So are we seeing a transition? Are we in a more balanced market? Yeah, I'd probably say that's the case. So those are the most interesting data points that I've seen in general. And just one more thing on new construction is that standing inventory. The reason why prices are down so much in the new build era is that they've got the number of homes that are built, ready to move into, that builders have. It's at a level we haven't seen since the fall of 2000, well, some of 2009, actually. So they've got a lot they need to get rid of.
Got it. So your point on inventory overall is there's a lot of focus, there's a lot of talk about how much inventory has gone up versus last year. But your point, Matthew, is that's not a comparison to a normal year. That's not really a fair comparison. Let's go back and let's look at those pre-COVID years. Where's the image today versus say 2019? And I think you said today it's down, it's 21%.
29, 29, I'm sorry, 29. That's about 21% lower. So if you look at that, again, it brings in more perspective. And that's the biggest thing, because certainly everyone looks at the media, and what do the media like to talk about? Doom, gloom, despondency, and pestilence and disease. However, is that really the right way to do it? I'd say not. But clearly, not just brokers, but also their clients, most importantly, buying a home for them is going to be, the 97% of them, the most expensive thing they ever buy in their lives. So they're going to be reading these headlines, and is that going to cause them a bit of concern just to pull back? Yeah, I think that's the case. But moreover than anything else, it's affordability, and we know where mortgage rates are, and housing is significantly less affordable today than it was over the last few years.
Yeah. So, Matthew, I think that you're starting to answer a question I was about to ask you. And this is a question I've been getting a lot. I think it's a question on the mind of a lot of real estate agents, also a lot of our clients. Why are prices still going up? Now, they're going up at a very slow pace now. They're obviously not going up double digits anymore, but they're still going up 1, 2, 3%. Why are prices still going up, even though inventory is so much higher compared to last year? And even though months of inventory has gone up significantly in most markets, but prices keep going up. Why is that happening?
Yeah. That's a great question. In fact, month over month, single family home prices are up by 3%, a huge number. So I thought, okay, well, why? How do you look at that? Well, go back and look at where mortgage rates were. Well, they averaged, 6.7, bit more than 6.7% in April, roughly 6.8% in May. So did we see a massive drop in mortgage rates that could be a trigger for buyers to say, okay, now's the time? Possibly if they were looking in April, obviously we've got June numbers now, that could be the case. But in general, I think that for well-priced and well-positioned houses, there is still demand. But the big problem that we've seen recently over the last couple of years is from the home seller's perspective. And when I say that, what do I mean? I mean that home sellers have been used to having everything their way for a long time. And therefore, they've been pushing list prices higher and higher and higher. And because the market was so tight, we saw exaggerated price growth. At the same time, however, we know mortgage rates were a lot lower. Now I think they're understanding that the market has shifted, and therefore homes that are priced accurately and appropriately, there's still demand. We're still seeing some bidding wars in some respects in certain areas. And that's what's pushing pricing up just a little bit. So I think that's what we're seeing, but it is that shift. I think the people that still expect their home to be worth $100,000 more than the guy next door, maybe that's not the case anymore. So if you are a broker representing home sellers, don't be bullied, price it right. There is still a market out there. It's not the amazing market that you saw over the course of coming out of COVID, but there is still a market.
Yeah, there's still a market for properties priced right, in proper condition. And we see that in many markets. So a lot of the ninjas that I talk to all across North America say that same thing. Matthew, sometimes we get, and I'm guessing you get it too from people, and these people would be prospective buyers, and the buyers say, you know what? I think I'm just going to wait. I'm going to wait for prices to crash. Matthew, and I'm sure prices are going to crash one of these days, and I'm just going to kind of wait around on the sidelines for that. What would your response be to that kind of person who's waiting for the market to crash?
You've been waiting a long time. I think that what we've seen with people let's go back a little bit, Eric, and through the early days of COVID. And all of a sudden, the government jumped in with a program called forbearance, which allowed people to not be foreclosed on, not pay their mortgage. However, at the end of that forbearance period, you had to make the bank right, and then you could continue on. Well, back then, again, a lot of brokers and certainly a lot of their clients were saying to me, oh, this is great. And within 3 months of COVID, 1 in 10 homes in America was in forbearance. And the expectation was that when that period ended, no one would be able to get right with their bank. We'll see a flood of foreclosures. Anytime you see a systemic drop in home values, and there's significantly more supply than there is demand. They say, well, this is great. Wait for forbearance to end, and then all of a sudden, what's going to happen? Everyone's going to be foreclosed on, and I'll pick up 3 homes on the cheap. These people are still waiting. It did not happen. And so I would say to anyone that's waiting, even though we're seeing prices escalate very modestly, well, the longer you wait, point one is that prices are not going to crash, even if they flatline. But over time, given appreciation we've seen, even if it's very modest, it means it'll cost you more. But more importantly, maybe there's that home you've been watching forever that you know you want to buy, but you're going to wait until prices drop. Well, if they don't, guess what? You might not be able to get that house that you always wanted. I'm not saying you should stretch yourself to a point whereby you're worried every night about your mortgage payment, but anyone that's saying that I'm going to wait for another repeat of 2006 through 2012, I think they're going to be waiting a very long time. Now, that maybe is a topic for a different time, but yeah, I just don't see the market crashing at all. Slowing down, certainly. Are we seeing some price reductions already in certain markets? Yeah, we're seeing them again in Florida, in the condo market. We're seeing them in Texas, certainly specifically around Austin. But a systemic decline, significant decline in pricing nationally, I don't see what would cause it.
History has shown, and you've taught me this, is that really what it takes for a systemic and significant decrease is a glut of supply and also a glut of distressed properties. And your point is that we're just not seeing it now. And today, sure, the inventory's up year over year, but we're still around just under 5 months inventory, and that's a balanced market. So
yeah, and it really is. And given the fact, again, with a lot of things we could talk about, household formations are slowing down, but we're also seeing household size shrinking. That means more homes for the same number of people. There's a lot of things that I look at when I'm trying to say to brokers out there, because my job is very simple. I want to give them the information they need so they make better decisions for their clients, and therefore brokers do better financially. If there was a crash, I would be screaming it from the rooftops, as I was in 2005, but I just don't see it.
yeah. Yeah, it's worth noting that you're hearing this opinion from someone who back in 2005, 6, 7 said was throwing up red flags and
Yeah, I mean, my dad qualified for a mortgage back then. Nothing good was ever going to come with that.
Yeah. Matthew, let's now talk interest rates.
Oh, yes.
A hot topic. And I want to have you start with sharing something that when you shared it with me, and again, I think this was 15 years ago, it was so insightful. You were the first one to ever connect these dots. And I'm forever grateful for this lesson. And the lesson I want you to share is about what is it that is directly tied to mortgage rates. And a lot of people make an assumption that the Fed funds rate is that there's a direct correlation between the federal funds rate to 30-year mortgage rates. You shared something insightful to me. I want you to share it. And I think this is maybe even more relevant now. There's like some extra pressure on the Fed chair, and so help people out, shed a light on that, on what is the correlation between the Fed funds rate and the 30-year rate, if any, and how does that work?
Sure. And yes, you're absolutely right. I mean, Jed Powell is having an interesting time right now, but I don't talk politics. I do talk policy, though. And we talk about policy, the Fed funds rate. Is there an impact? Sure, you could say there is. So it has something to do with mortgage rates. And why? Well, it's marginal, but it can increase the cost of capital for banks. Now, if you're not selling a mortgage through Fannie or Freddie, well, that is important. And it does impact what's called the yield curve. And that has a modest impact as well. But if you really want to look very closely about how mortgage rates are created, in the first place? Well, let's go back to when they were created back in the early 70s. And what the government did when they created Fannie and Freddie is that they said, okay, let's take the yield on 10-year treasuries of the bond market and add on a risk premium. Why? Well, there's always going to be a certain amount of risk associated with the mortgage as opposed to a bond. And that is where the mortgage rate should be. So take the yield on 10-year, add on the premium, which used to be about 1.8%. It's more than that now. Maybe we'll talk about that in a second. But that is really, if you want to look at where mortgage rates are going or where they've been, then just yield on 10-year, add on. If you think about spread between mortgage rates and the yield on 10-year treasuries, very, very stable spread. Now, compare that same interest rate on mortgages as opposed to the Fed funds rate. Well, I mean, you've got to sprint really hard to find any correlation at all. So, yes, they have an influence, but certainly it's not as big as when you hear maybe certain politicians saying, well, we have to reduce the Fed funds rate because that's going to pull mortgage rates down. No, it won't.
Got it. Because there's some indirect correlation there, but
yes,
directly what you look at is the 10-year rate.
Yeah,
and
indirectly, yes, it does. But quite frankly, when you hit the administration say that you've got to lower interest rates to 1%, that's going to mean mortgage rates going to come down. Isn't necessarily going to be the case.
Yeah. And I would encourage everyone to look this up. Go to Google and search 30-year rate, 30-year mortgage, 10-year treasury, and look for images and go look at a graph. There are lots of graphs like this out there that show the 30-year and the 10-year in the same graph, and get it over a period of time. And what it's going to look like, guys, are railroad tracks. Those two lines track each other. And again, as Matthew said, that it tends to be, they're about 1.8% apart, but they track just like railroad tracks. So as the 10-year goes, so goes the 30-year. So if you want some indication where the 30-year is going, track the 10-year. Today, I just looked, Matthew, the 10-year today is at just under 4.4%.
Yeah.
Right. And so historically, the spread has been like the distance between the railroad tracks has been 1.8%. And so if you add 1.8% to 4.4, then you get 6.2. But today rates are higher, 30 years higher than that. So that's what you're calling the risk premium. So why is that? Why?
Well, no, actually, the risk premium is the 1.8%. The reason why it's higher now is that you've got banks, they've added more in, because, yes, their cost of capital has gone up because of the Fed funds rate. We get that. That makes sense. But it's a prepayment premium. The banks thing. What I mean by that, they're basically trying to get more money up front because they believe that mortgage rates will come down. And as they do, people that bought homes at 7%, they will refinance. And what happens to the revenue for that bank? It goes away. So they're trying to get more money up front. And that's the reason why the premium now is about 2.4, 2.5%, which is well above where it should be. But that's the reason why.
Got it. Do you see that changing?
I think that, again, why I believe that mortgage rates ultimately are going to come down is that over time, I think that spread is going to start trending back toward that below 2%. So even if the 10-year treasury yield doesn't change, you can still see mortgage rates come down.
Got it. Okay. So would you argue that as you say that your belief is that rates will trend down? Are you saying that mostly because you see that spread getting more back to normal, or you see the 10-year yield coming down?
I think ultimately the 10-year can come down a little bit from where it is. However, I think it's my position that what's called the terminal rate, the terminal rate meaning the long-term rate for the 10-year treasuries, is around 4%. Now, why do I think that? I'm afraid you've got to look at this country's debt. The national debt levels right now are around, $36.5 trillion. And that isn't yet including the big bill which just passed through Congress. So in order to pay the interest on that debt, the government actually issues more debt in the form of bonds, of treasuries. And so the question is going to be how much demand is there going to be for those bonds? And so because to get more demand, what do? You have to raise the interest you will pay a country. We own most of our debt ourselves through the Social Security Trust Fund. But Japan is the number 2 owner of US debt. Great Britain is actually number 3. China is now number 4. So how much more do they want to take on? And so because of that, I do expect a slight decline in 10-year paper, but that means one thing, and that is that we can see mortgage rates come down. But anyone expecting to see a 3 or 4% 30-year rate, don't do that. That should, I say, should never have happened. It was artificial because of the Fed. So they've pushed rates down to a level which should never have happened. Now, we've seen rates drop down really since the 80s. And every decade they've come down. They can't come down to zero. So I think that we are closing in on around 6%. And I think that over time, the terminal rate for 30-year fixed rate mortgages going to be around that 6% level. Can't over and do below it. She can do if we have a recession or modestly above it. But again, I think that's going to be ultimately the long-term rate for 30-year financing.
Okay. So you're saying ultimately the probably floor is not an accurate term. That wouldn't be fair to say, but you said rates settling in around 6%. And you just explained the logic. First piece, the 10-year treasury yield, you see settling in around 4%. You don't think it can really go below 4% because there needs to be perceived to be an attractive interest rate for people to purchase those bonds. And then then you see that the spread between the 30-year and the 10-year getting back to more, quote, normal, closer to 2%, hence 6% on a 30-year rate.
And that's exactly it. And again, a lot of things come into play in that respect as well. And a lot of it is driven, when we talk about other countries buying our debt, on the current tariff conversations that are being had. Now, beyond the fact that can be inflationary, and again, you think about if you're lending money over a 10-year term, you've got to make sure your yield, your return on that is going to be above the rate of inflation. Otherwise, you're actually losing money. So a lot of different things come into play. Yeah, but ultimately, I think that probably will be. I think seesawing either side of 6%, probably where our mortgage rate's going to be over the course of the next 20 years.
Okay.
However, they can go below that if we have recessions. And that invariably is why this money moves into safe harbor, into bonds. Price goes up, yield, interest rate comes down.
Okay. Makes sense. Makes total sense. You brought up tariffs.
Yeah.
Let's talk a little bit more about tariffs. People, obviously a lot of news about tariffs, a lot of talk about the tariffs. How will tariffs impact real estate? How are tariffs impacting real estate today? What does it mean for real estate?
A lot of things. I think that in the broader aspect, I mentioned earlier on, buying a home is very, very expensive. It's the most expensive thing for most people. And these tariffs cause a certain amount of uncertainty. And what do we do when we are uncertain about anything? We do nothing. We freeze in place. So I think that's uncertainty. We've seen, obviously, inflation rise modestly last month. I think that will continue for a while. That does a couple of things. It means less cash in people's pockets to make those mortgage payments. That's going to impact the market. And on the new construction side, higher costs for builders and higher inflation for builders. I mean, 27% of the things that go into a new build home are imported from China. 11% things come from Mexico, 8% from Canada. So it's that. What does that do? That means it's more expensive for the builder. It's more expensive for the end user, for the buyer. So I think certainly, without a doubt, we've got a situation that builders they just don't know, because the goalposts, as we all know, continue to move. Tariffs one day, push it down the road the next. Who knows what it's going to be? But they said that 54% of all household appliances are imported from China. 70% of sheetrock comes out of Mexico. There's a lot of things we bring in to build. So builders are having a hard time. Guesstimate it's costing them right now about $9,000 more per house than it did because of tariffs. And from the ownership side, again, less money. If we see that the cost to live goes up, inflation, a lot of that has an impact on the mortgage payments we can make. So there are some very direct and indirect impacts of the current tariff tantrum that's currently going on.
Got it. Are you seeing builders slow down new home starts because of the uncertainty? I mean, yes, the demand is slowing down for them, but are you watching and hearing about, do you know about builders who are maybe not fully pressing pause, but really slowing down production until they have more certainty around tariffs?
Oh, very, very much so. And a lot of that's not just because of the cost, but they're looking at the number of homes that are out there. So with the new construction world, I look at sales and inventory levels. based upon, was that house ready to move into? Was it being built, or had it not yet been started? And in standing inventory, as I mentioned earlier on, it is, which are homes ready to move into tomorrow. Highest level since July of '09. Overall listings, including houses that are currently under construction, as well as those that haven't yet started construction, that's at a level we haven't seen since October of 2007. So they want to get through this existing inventory. And eventually, tangential point to what we've been talking about, though, if you look at new construction sale prices, down almost 5% in the month in June, down almost 3% year on year. But here's the thing. We know where resale sale prices are. Last month in June, $441,500 was the median sale price of a single-family home. But that is well above the median sale price of a new construction home. So new construction is competing with the resale market. That's another thing which I think a lot of many brokers, also, I would say home buyers, are looking at. So for the ninja people out there, when you're looking to price a home for a client, if you have, especially during the Sunbelt markets, big exposure to new construction, go down, take a look at what pricing's like for new homes, because that, I think, is going to tell you a lot as to how much you'll be able to achieve for the home you're looking to list.
Got it. And you see downward pressure on new construction. Builders are sitting on a lot of inventory. A lot of those builders are publicly traded, and they have certain quotas that they have to hit, certain number of transactions that they're trying to hit, and they'll do what it takes through price, through interest rate incentives. So in a lot of our markets, new construction can be a big part of our competition for when we're trying to help a seller sell their.
Yeah. So as I mentioned earlier, the median resale price last month was $441,500. What was the median sale price of a new construction home? $401,800. I mean, that's a $40,000 spread. Resale is that much more expensive. So and I think that without a doubt, they're reducing prices. We know that. Also, you're seeing mortgage rate buy downs, a lot of other incentives that builders are putting out there in order to get rid of that standing inventory, because the homes they've built, they haven't sold, are doing what? They're costing builders money every single day in interest. So that, I think, is why they're being very enthusiastic when it comes to trying to get rid of those homes.
Yes, absolutely. Okay, Matthew, let's talk about number of transactions. And for our clients, we care a lot about price. And for the industry, the number really that matters for the industry is the number of transactions that are occurring. Right? How many sales are actually happening? So today it's just under 4 million. A year ago, it was right about 4 million. That post-COVID time, 2020, 21, 22 was 6 million, 6.5 million. But before COVID, it was around 5 to 5.5 million. So as someone in the industry, it feels like number of sales have been stubbornly stuck at around 4 million for quite some time, for many months in a row. When do you see it getting back to not 6.5 million, but at least more toward 5 million? When do you see that changing? What would trigger that? And look, we say a lot that we focus on abundance. 4 million is a lot. That produces a lot of commission revenue. We can work with that, but we'd also like it to get back to 5 million. So when do you see that happening, Matthew?
Well, I think there's a lot of great question you actually answered within your introduction to it. So rates, mortgage rates, and prices being affordability are the two biggest components you need to track. But demographics, they're still going to prevail. But through the pandemic, as you very accurately mentioned, that pulled a lot of sales forward. Now, as you mentioned, 5.6 million transactions in 2020, 6.1 million in 2021. So for perspective, again, as you mentioned, the last time we exceeded those numbers was in 2004, 2005, and 2006. But now, as we talked about already, new construction is competition. And so that is going to be taking away maybe a bigger share of transactions is going to go to the new home market rather than existing. And again, we've already talked about why. But again, geographically, it's going to be very much more in the Sunbelt where the big three builders are in place. Now, even around what, 4.2, sorry, well, 4 million, as you mentioned, year on year perspective. And the annual average in the 1990s, well, that's actually more today, annualized, than it was back then. Still about 500,000 units lower than we saw in the 2010s. But if rates fall by more than I expect, that certainly, I think, is going to have an impact. You mentioned, yes, 4 million is still a lot. I think another way you can look at it is look at the number of real estate brokers in the country. Anytime the market's becoming very ebullient, doing remarkably well, everyone wants to become a real estate broker. But when it becomes work, well, then people in Ninja and the people who have been through some of these bad periods, they prevail. People that throw this easy way to make money, don't disappear. So your share of total transactions as a broker actually goes up if there are fewer brokers in the marketplace.
Got it.
So we're seeing that going up. So I do think, ultimately, you've got the second half of the millennial generation. They are moving away now from casual hookups into having real relationships and children. They want to buy, but the question then is going to become, where can they afford to buy? But from a demand perspective in aggregate, I think we've got 15 plus years of solid demand if we can produce, or there are homes out there in the country that these first-time buyers can afford to buy. The median age of a first-time buyer last year was 38. Supposed to be around 30 to 32. So a lot higher. Why? Because, again, affordability. So I think that we can see mortgage rates come down. I think we will. They're not going to collapse. Pricing not going to collapse. So I expect to see a modest increase. But to that 5 million, though, in my forecast for 2025 is about 4.2 million. I think we'll see about 4.4 million, maybe 4.5 in 2026. So better than we've seen. Maybe it's what Ninja brokers can live with rather than what they want. So it's going to gradually get better. But those heady days that they saw coming out of COVID, it's going to be a long while before we get back there.
Yeah, but a gradual increase. And hey, ninjas are optimistic and positive, and we like that kind of news. We can work with that. We can work with 4 million, and gosh, 4.2 million, 4.4 would be even better. Okay, Matthew, last question.
Yes.
So the national media, when it comes to real estate, they focus on certain things. The industry media, when it comes to real estate, they focus on certain things. Lately, as you know, it's been a lot about like infighting within the industry. But what I want to know is, what do you focus on? What are you watching? What are you paying attention to? What are the numbers that are important to you? What are the trends that are important to you? I want to see the real estate world through Matthew Gardner's eyes. We're all like pulled. Our eyes get pulled in certain directions by outside influences. But what are you looking at?
Oh, be careful what you wish for. I mean, I'm the guy that actually dreams in Excel. But obviously, household creation is important. Again, shelter. We've always needed shelter. We will always need shelter. No question about it. So are we therefore always going to transact housing? Yes, we will. But from a demographic perspective, my biggest worry out there are our first-time buyers. When I say that, I look at my son. He's going to be becoming senior at university starting this fall. When he gets done with that, and even does grad school, I worry about where he'll be able to afford to buy his first home. He's not moving back in with me, by the way. So, but it really is that. We've done remarkably well. Housing is how most households in this country create wealth. And the problem, as I see it, is that I look at these young kids creating new households, looking at a marketplace where us more mature people have done really well, made a lot of money on housing, but we are stopping them from getting their foot on the first rung of the housing ladder. That is what scares me the most.
Absolutely. And you brought up something really important in real estate, I think, and that is that first rung on the ladder. And it's an opportunity, right? It's an opportunity for local municipalities, landowners, developers, builders to collaborate together on how to make that better. Matthew, you've given us so much value, so many takeaways. I want to encourage everyone to check out Matthew's LinkedIn page. Matthew, very active on LinkedIn. Lots of value that you add there. Oftentimes with visuals, those visuals and the graphs you create are terrific. I think in roughly a month, you're launching a new YouTube channel. I encourage everyone to be on the lookout for that. I personally, I can't wait for that. And Matthew, if anyone wants to reach out to you to get help, keynote, I know one thing you also do is that you hold private client events
Mhm.
for real estate brokers who want to have a special event, either virtual or in person for their clients. You do that. Lots of ways you can help and add value. What's a good way for people to reach out to you?
Well, thank you. It's very kind of you. As you mentioned, yes, I'm starting my new podcast in September, as you know, Eric. For many, many years, actually started in the very early days of COVID. I did a monthly, actually weekly back then, video, moved to monthly. Took about an 18-month break away from that. But a lot, as we all know, real estate brokers are fairly vocal of people telling me start it up again. So that's what I'm going to be doing, and doing a bit more of a deeper dive into the issues that are important, not just for brokers, but things that they can share with their clients. So that's going to be coming up fairly shortly. And as you mentioned, my social channels, Facebook and LinkedIn, if you just search, I'm Matthew Gardner, or actually the link is MJD Gardner. That will get you to my Facebook and LinkedIn, and email m.gardner@gardnereconomics.com. Love to hear from anyone. If you happen to have a question or something your clients ask you about which you can't answer, I will do my best. And if I don't know the answer, I'm pretty sure I know somebody that does.
Right.
So
Great.
my job is to try and make brokers more successful and do the best things for their clients.
Yeah, you are famous for that. You've been doing that for a long time. You certainly did that today. I'll make sure that what you just mentioned for your Facebook, LinkedIn, email address are put in the notes.
Thank
People
you.
can reach out to you. Ninjas, at a minimum, reach out and say thank you to Matthew for all the value that you added. Matthew, I'll say thank you to you right now for all the value that you added. Always enjoy our time together. I always walk away with so many takeaways, so many light bulbs going off for me, so much more clarity and insight. You are such a value, such an asset to our industry, and I'm forever grateful to you for that.
Oh, my friend, you're awfully kind. Great seeing your face again. Glad you're doing well, and everyone else around you. But yeah, this has been a lot of fun. Hopefully all your ninjas out there at least get something of value out of the conversation we've had.
I know that they did. I know that they did. So, ninjas, your job is to go share this, go share these takeaways, go help your clients. Thank you, ninjas, for joining and for engaging as always. And we look forward to seeing you in the next podcast. Thanks so much. Bye.